Anand Radhakrishnan, Managing Director with Sundaram Mutual Fund, joins us. Let's take our conversation forward. And nice to have you back. Thank you for joining us.
Good morning. Thanks.
What do you make of the current market setup? It's quite encouraging and impressive to see that how markets have managed to climb the wall of worry. Whatever could go wrong has gone wrong in the last 6-8 months, but markets are firm like a rock, not only in India but globally also.
Yeah, after a dip during the month of Jan, Feb, March, etc., we have seen a smart recovery from the market, not only in India, across the world. Specific to India, we have seen financial conditions relatively easing up. We have seen cut in interest rates, cut in CRR, risk weights reducing in the banking system and NBFCs, etc. We have also seen moderation of inflation and improvement in wages, especially on the rural side, wage growth, etc. So by and large, the incremental data has been positive, and this is also reflected in some of the high frequency numbers like GST collections, e-way bill plan, etc., momentum, etc. And for the year ending fiscal 25, we have also seen very good corporate numbers across the breadth of industries. The record number of companies are declaring double-digit growth. All of it seem to have had a positive effect in pulling up the overall market.
Okay. Where do we go from here in terms of the next trigger? Because the earnings have not been great. While demand is there in terms of FI, SIPs, etc., we are not seeing a lot. We are also seeing a lot of demand. So if demand and supply is getting imbalanced, is getting balanced, triggers are not there, earnings are slowing down, what could take the markets higher from here?
No, aggregate demand is pretty robust, Nikunj. What is the best indicator of aggregate demand? There are many indicators. We tend to track many. For example, people say index of industrial production is a good measure of manufactured good. But I personally think, GST is a very good measure because it is on goods and services that is sold. Government is collecting tax. And if you look at it, it's been trending in mid-teens in the growth. So aggregate demand seemed to be pretty okay. Yes, there are pockets of slowdown and there are pockets of relative strength, if I may say so. And therefore, from that perspective, we can say that we are in a healthy situation. Incrementally, since you're asking that what can change, is that one is the benefits of rate cut will trickle down both into the listed corporates and unlisted corporates, etc. The liquidity improvement should make credit availability easier, and that currently the credit growth is a bit tepid. I think it's less than 10% or so, especially on the corporate loan growth. So it can lead to some improvement and some kind of financial conditions becoming easier for companies, and that should be positive. The second area which can improve is on the consumption side, post the tax relief and the fall in interest rates, and possibly a good wage growth and an impending wage revision for government employees. We might actually see consumption getting a leg up, both on the urban side, on the rural side. Consumption is more than 50% of the economy, which has been on and off, it's been blowing hot and cold. And we can see a more decisive positive trend there as well. And we will see a continued kind of a growth on the investment side, both from the government and corporates. So I think many legs of economy seem to be reasonably aligned, and at the margin, we would see both the benefits of interest rates and consumption to trickle down.
All right. Hi, Anand. Morning. This is Shrishti also joining in. But Anand, the next big trigger, or rather a date that everybody is watching out for, is 9th July. Help us understand that how do you see the markets headed towards that? Because for today, there's still a lot of uncertainty and some reports suggesting that this deadline could be pushed back. But what sentiment are you getting for the markets, given the fact that some of the US markets are very near to their all-time high levels, and the Indian markets, emerging markets, they are doing very well today?
Thanks for that question. You were right in the sense that after the initial jitters on the tariffs, markets seem to have shrugged it off, partly because of the rollback of the U.S. government on some of these issues, as well as a time period window getting extended, etc. U.S. in itself is looking to kind of moderate interest rates, and the government wants the interest rates to ease up, and the dialogue between the government and the central
Recording stopped.
Seem to be veering towards, the inflation moderates in US, there's a scope for rate cut, and tariffs seem to be coming in between the inflation and the rate cuts per se. So in some sense, there is a pressure there to be moderate on the tariff side so as to pave way for rate cuts, and then that should kind of give some tailwind for the economy to grow a little bit faster. And I think growth is imperative for even markets like US, economies like US, and we would see, therefore, at the margin, the balance tilt in favor of moderation in the tariff efforts than what we have seen earlier. In which case, I think markets seem to be sensing it in some sense, and in which case we seem to be finely positioned.
There are a lot of themes in this market: solar, EV, defense. They are called as narrative stocks. Hindi mein we would say kahani companiyan. Where are these strong narratives moving? Because that's where a lot of fresh money is moved into defense stocks, into railway stocks, into solar stocks, into EV stocks.
Yeah, there are multiple themes in the market currently operating. One is on the sustainability theme, where not only in India, globally, there has been a concerted effort to push towards decarbonization, alternate energy, electrification, recycling, etc. And in India also, some of the companies that have been engaged in these spaces have generally got some tailwind. I expect, though on the margin, we have seen some moderation in the global push towards sustainability because of various policy issues globally. We have seen that in domestic market, there is a reasonable continued tailwind on that. There are other themes also which have been currently focused. One is on the manufacturing side. We have seen defense being subset of the Atmanirbhar or Make for India kind of a theme. We have seen reasonable strength. Even the companies have been declaring good numbers on the manufacturing side, be it all the industrial goods companies as well as defense manufacturing companies. Some of the companies that supply ancillaries and equipments to railways, many of them have been declaring good numbers and have healthy order book. So that theme continues to remain fairly strong. And of course, the third theme, which we feel a little bit is gaining momentum, is the so-called premiumization trend. As the income levels go up, the demand for goods and services, especially on the premium end of the market, has been going up, be it in automobiles, financial services, wealth management, apparel, retailing system. Multiple sectors, there has been the companies that are engaged in the manufacturing and the delivery of premium goods and premium services have been trending at a faster growth rate. And that is why that companies are less volatile, their earnings seem to be more resilient and provide a very good multi-year growth opportunities. And finally, the fourth trend which we see in the market is the technology-based disruption companies, like the existing listed companies like Eternal, Swiggy, Policybazaar, etc. We also expect more companies, be it in the area of logistics, delivery system, e-commerce, fintech, food tech, healthcare technology. So some of these new age companies Though they tend to be more volatile. There's a lot of uncertainty around their profitability. The business models are nascent and evolving, but some of them are pretty strong and have established a moat and a footprint in the marketplace, and we would remain very constructive. So a combination of all these four things: sustainability, premiumization, manufacturing, and technology-based disruption look pretty interesting as the markets stand today.
Okay, Mr. Radhakrishnan, hi, morning. This is Nehi also joining in. If you take a look at the valuations in the market right now for the broader end of the market, they still continue to remain higher than their historical averages. And still, barring the last couple of trading sessions, you've seen outperformance from the SMID basket. Where do you believe the broader end is placed in terms of valuations, and what's your outlook on large versus the SMID stocks?
So clearly, the earnings growth is a little more healthier as we go down the cap curve. Large cap companies' earnings growth, declared earnings growth, are less than the mid and small sized earnings growth. So to that extent, one can justify a growth-led premium as we go down the cap curve. But growth is not the only reason why stocks should value. There are stabilities, qualities, capital efficiency, transparency. There are many issues where we still have to justify why we should pay a significant premium to small companies. As we go down, while the growth gets more interesting, the valuations make it very tightrope walk for us, and therefore we need to trade off between good growth companies which are valued very richly and the moderate growth companies that are valued a lot more moderately in the marketplace. Yes, we are sacrificing growth for some margin of safety, but from a portfolio perspective, that is a very tricky trade-off fund managers have to make while they are investing down the cap curve. Within the large cap, we do see pockets of dull growth. For example, IT companies have been growing at low single digits, and the visibility seems to be still very challenging for them. Some of the commodity companies continue to be be volatile in earnings, and there is no clear trend on global commodity prices, which makes it tough for one to allocate big money. Similarly, the utility companies are a little bit low growth. So yes, within the basket of large caps, the proportion of a moderately growing company is very high, whereas in the mid and small size, we see the breadth being pretty healthy, etc. Now, one more point, therefore, on valuation is that one is because of the growth-led valuation, the other is the liquidity-led valuation. As we speak today, the mid and small size companies seem to be predominantly supported by the domestic investors, not so much by the foreign institutional investors per se. So we need to be a little careful and watchful of the domestic liquidity conditions.
All right, Mr. Radhakrishnan, with this, we let you go on that. Thank you so much for taking the time out today and speaking with us.
Thank you so much. Have a good day.
Same to you. But with this, let's have a quick look what the markets are up to. So for now, Nifty 50 is holding on to just mere 6 points of gain, trading absolutely flat, while